Conduct were at the heart of the financial crisis.
More than 4 years later,
no one going to jail, no individuals being held accountable.
This is totally about what went on Wall Street.
Frontline investigates why no Wall Street executives have gone to jail.
Goldman Sachs beat expectations for quarterly profit on Monday, driven by strength in deal making.
This downturn started in the housing sector and in the financial sector. You're seeing a lot of things being hit.
In 2009, at the peak of the worst financial crisis since the Great Depression, while millions of Americans were losing their homes, their jobs, their retirement savings, Goldman Sachs paid out $16.7 billion in employee bonuses. In the same year, its CEO, Lloyd Blankfein, sat down for an interview and, with a straight face, described what Goldman does as doing God's work. That quote became infamous. It also, accidentally, told you everything you need to know about how Goldman Sachs sees itself and how it operates. This is the story of a bank that started with a German immigrant buying merchant IOUs in a basement. A bank that grew into the most powerful financial institution on earth. A bank that helped engineer the 2008 financial crisis, bet against the same products it was selling to its own clients, got bailed out by taxpayers, walked away more profitable than ever, and then did it all again with a brazen billion-dollar fraud in Southeast Asia. And through all of it, every scandal, every Senate hearing, every billion-dollar fine, not one senior executive went to prison. The story starts in 1869, not a gleaming skyscraper, a one-room basement office in Lower Manhattan. Marcus Goldman was a German immigrant who'd found a simple but smart gap in the market. Small businesses needed short-term cash, but traditional bank loans were hard to get. Goldman started buying their promissory notes, essentially IOUs at a discount, then selling them on for a profit. He built a reputation on trust, and the business grew. By 1885, his son and son-in-law were partners. Goldman Sachs & Co. was born. They joined the New York Stock Exchange in 1896 and started pioneering the use of IPOs, helping entrepreneurs raise capital in ways that hadn't existed before. One of their early landmark deals, taking Sears, Roebuck & Co. public in 1906, transforming American retail in the process. For nearly a century, Goldman ran as a private partnership. And this structure meant everything. The partners invested their own money. Their personal fortunes were tied to the firm's success. Their reputation was the single most valuable asset they had. The culture that grew from this was genuinely client-first, not because it was written on a plaque somewhere, but because the people making decisions had real skin in the game. For 130 years, Goldman resisted going public. The conversation came up internally as far back as the 1960s and was shot down repeatedly. Partners worried that outside shareholders would gut what made Goldman shifting focus from long-term relationships to short-term quarterly profits. By 1998, they were the last major private investment bank on Wall Street. The pressure to compete with publicly traded giants was simply too much. On the 4th of May, 1999, Goldman Sachs went public. The stock surged 33% on its first day. The partners became fantastically rich overnight, but it was a cultural earthquake. The old Goldman, the one where partners' names were on the door and their own money was on the line, was gone. A new Goldman had been unleashed, a publicly traded giant with an insatiable appetite for growth, answerable to shareholders who wanted returns, not relationships. That new Goldman would be tested less than a decade later. In 2009, Rolling Stone journalist Matt Taibbi wrote what became one of the most famous sentences in financial journalism. He described Goldman Sachs as a great vampire squid wrapped around the face of humanity, relentlessly jamming its blood funnel into anything that smells like money. The description was hyperbolic. It also stuck because a lot of people felt it captured something real about what Goldman had become. Here's what actually happened in 2008. In the years before the crisis, Wall Street had gotten hooked on mortgage-backed securities. Banks bundled thousands of home loans, many of them risky subprime loans, and sold them as investment products. Goldman was a major player in this market. But, by 2006, Goldman's own internal emails showed that senior executives had started privately describing these products as junk and crap while continuing to sell them to clients. What came next was the key move. Goldman started betting against the very same market it was selling to investors. They used complex instruments called synthetic CDOs to take massive short positions on housing, essentially buying insurance that would pay out when the market collapsed. Then came a Bacchus 2007 AC1. Goldman created this investment product and sold it to clients. What those clients weren't told, a hedge fund called Paulson and Co. had helped select the specific assets inside a Bacchus, deliberately picking the ones most likely to fail because Paulson was planning to bet against it. Goldman didn't disclose this to the investors buying in. When the housing market crashed, Bacchus investors lost over $1 billion. Paulson and Co. made $1 billion. Goldman collected its fees. In July 2010, the SEC charged Goldman with securities fraud over Abacus. Goldman settled for $550 million at the time, the largest penalty a Wall Street firm had ever paid to the SEC. They acknowledged their marketing materials contained incomplete information. They did not admit wrongdoing. September 2008, Lehman Brothers is filing for bankruptcy. The global financial system is in freefall. Goldman made a series of moves that saved itself and enraged everyone else. On September 21st, in an emergency Sunday decision, the Federal Reserve granted Goldman the status of a bank holding company. This gave it access to the Fed's discount window, cheap government money normally reserved for stable commercial banks. A lifeline that came through over a weekend. 2 days later, Warren Buffett announced a $5 billion investment in Goldman. It wasn't just capital, it was the most powerful public endorsement money could buy. Then came AIG. The insurance giant received a $180 billion government bailout. And nearly $13 billion of that taxpayer money flowed directly to Goldman Sachs, paying out its contracts at 100 cents on the dollar, full face value. No haircut. Goldman didn't just survive the crisis. It was made whole by the government, backed by the world's most famous investor, and emerged more profitable than ever. By 2009, bonuses were back to $16.7 billion. Its CEO was publicly saying the bank was doing God's work. The public fury was immediate and lasting. The nickname, Goldman Sachs, stuck. But the fury also shone a light on something that had been operating in plain sight for decades, the revolving door. Henry Paulson, the Treasury Secretary who personally designed the 2008 bailout, former CEO of Goldman Sachs. Robert Rubin, Treasury Secretary under Clinton, former Goldman co-chairman. Mark Carney, later Governor of the Bank of England, Goldman. Mario Draghi, later President of the European Central Bank, Goldman. Steve Bannon, White House Chief Strategist under Trump, Goldman. The list runs across administrations, across parties, across continents. If 2008 was about exploiting systemic flaws, the 1MDB scandal was something else entirely. It was just a brazen criminal conspiracy. Between 2009 and 2014, Goldman was hired by the Malaysian government to help its state investment fund, 1MDB, raise money for national development projects. Goldman arranged 3 bond deals, raising $6.5 billion, their fee, $600 million, nearly 10% wildly above market rate. That alone should have been a red flag. The money was supposed to fund schools, hospitals, infrastructure. Instead, working with a Malaysian financier named Joe Low, 2 of Goldman's own senior bankers engineered a massive bribery scheme. The US Department of Justice showed that more than $2.7 billion was simply stolen. Over $1.6 billion went in bribes to officials in Malaysia and Abu Dhabi just to secure the bond deals in the first place. What did the stolen money buy? Super yachts, private jets, luxury real estate, wild parties. And this is real, the financing for the Hollywood film, The Wolf of Wall Street. A movie about Wall Street fraud, funded by actual Wall Street fraud. The DOJ called it their largest kleptocracy case ever. In October 2020, Goldman pleaded guilty. The firm paid over $2.9 billion in settlements. Senior banker Tim Leissner pleaded guilty and forfeited over $40 million. Roger Ng was sentenced to 10 years in prison. Goldman's internal controls had completely failed to detect or stop a criminal enterprise running at the highest levels of the firm. Here's the pattern that runs through all of this. The 1929 crash, Goldman was there. The dot-com bubble, Goldman was there. The 2008 financial crisis, Goldman was there, selling products it privately called garbage while betting they'd fail. The 1MDB scandal, Goldman was there, collecting a $600 million fee while billions were stolen. Matt Taibbi's formula for how Goldman operates: inflate a bubble, collect the bonuses, watch it crash, pay a relatively small fine, and repeat. The fines are real, the Senate hearings are real, but no senior Goldman executive has ever faced criminal charges for the 2008 meltdown. The bank survived, thrived, and today remains one of the most powerful financial institutions on earth. Its defenders will tell you Goldman provides essential liquidity, finances, innovation, and that its alumni bring real expertise to government. Its critics will tell you that a bank which is simultaneously too powerful to fail and too connected to face real consequences is a structural threat to democracy, not just to your portfolio. Both things might be true. What's undeniable is this. From a German immigrant's basement in 1869 to a presence in every major government and market on Earth, Goldman Sachs has never stopped finding the blood funnel. And it has never really had to stop. Subscribe to Stag Research if you want to keep pulling back the curtain on the institutions and systems that actually run the world. This is exactly what we're here for.